Hey everyone, Andrew here. Let's talk about something that's making headlines, but also hitting a little closer to home. Trump's big, beautiful bill and what it could mean for your retirement portfolio. Now, I know what you're thinking. Wait, what does the policy bill have anything to do with my money? Well, potentially a lot. The real question for retirees isn't just about what's in the bill. It's, will it affect how long my money lasts? While your savings stretch like they planned, or could changes in taxes, spending, and policy quietly chip away at your security? So instead of diving into the politics, let's break it down financially, simple, clear, with one goal in mind, helping you make smarter decisions. We're going to use a before and after framework to look at 4 key areas: your income and taxes, where you invest, what your money earns, and how secure you actually feel. So let's jump in. Before and after, your income and taxes. So before, the 2017 tax cuts were set to expire in 2025. The standard deduction was higher, but it was temporary. Estate tax exemptions were also going to shrink. Now let's look at after, if the bill is passed. Those tax cuts, they become permanent. Higher standard deduction, that stays. The exemption for estate climbs to $15 million per individual, $30 million per married couple, starting in 2026, and then it's automatically adjusted for inflation. That's up from $14 million exemption currently scheduled to expire after 2025. There's even talk of excluding tips, overtime, and potentially Social Security from being taxed. So what does this mean for you? Your retirement income might stay more tax efficient, helping your money last a little bit longer. And when it comes to legacy planning, passing wealth to your family could become even more favorable. So what are some of the biggest action steps you can take? Now's a good time to revisit your income strategy, your withdrawal plan, and estate documents. There could be real opportunities here. Next, let's talk the before and after of where you invest. So before, growth stocks, think tech, dominated retirement portfolios. Clean energy and EVs got major tailwinds from federal credits. U.S. manufacturing, pretty quiet. But after, if it's passed, tax incentives pivot to U.S.-based manufacturing and infrastructure. Clean energy perks may get rolled back. Traditional energy and industrials might catch a second wind. So what this means for you? We could potentially see a rotation in market leadership. A tech-heavy portfolio might not lead the way anymore. Meanwhile, value stocks and U.S.-centric companies could start shining. Don't forget overseas as well. So some of the action steps you can take. Take a fresh look at your allocation. Think about rebalancing towards maybe dividend payers or sectors positioned to benefit from this new policy. Next, the before and after of what your money earns. So before, interest rates were rock bottom. Bonds underperformed inflation. Lower risk meant lower returns. But after, if it's passed, government borrowing could rise significantly. That pushes interest rates and treasury yields up. Suddenly, cash and fixed income options start looking attractive again. And what this means for you, short-term treasuries, CDs, and bond ladders might finally give you a solid income without taking on extra risk. But be careful, those long-term bonds could take a hit if interest rates rise. So action steps, reevaluate your bond game. This might be the time to shift from long duration to short duration, safer income options. The before and after of how secure you may feel. Medicaid and SNAP support was widely accessible. National debt was high but stable, and most retirees felt confident in the safety net. But after, if the bills pass, SNAP eligibility tightens. Higher work requirements, more red tape, Medicaid coverage cuts, right? Stricter rules, frequent recertification, millions losing coverage potentially. And the debt ceiling is raised by $4 trillion, fueling a surge in national debt. Debt added inflation and interest rate risk. According to the CBO, they project trillions more in debt, which is not sustainable, and it puts pressure on rates. What this means for you is increased economic uncertainty and less reliable government support, a new risk of inflationary pressures, and also market turbulence. So some action steps you can take. Stress test your retirement plan. Confirm you've got the right mix of growth, income, and defenses. Be ready to pivot if volatility or policy shift really starts to hit. So final thoughts. Prepare, don't panic. Look, this bill looks like it's not law yet, but it's moving fast. And even if this draft is formed, it signals big changes ahead. If you're nearing or in retirement, the message is very clear. Don't wait. Get ahead of it. Review your plan, your taxes, your investments, your income sources, and your estate strategy. A few smart moves today could mean years of peace of mind later. And if you've got questions or want a second set of eyes on your plan, reach out. We're here to help. And as always, stay informed, stay invested, and stay intentional.